The Reserve Bank makes its official cash rate announcement tomorrow morning. The OCR currently sits at 2.25% and most analysts aren't expecting a reduction. But Bernard Hickey, analyst and publisher of the Hive newsletter, has pointed out the Reserve Bank has constantly overestimated inflation of late, setting the country's OCR on the basis of projections that haven't been correct. This means the Reserve Bank hasn't moved interest rates as low as many outside the bank have been predicting, and inflation has been below the midpoint of its official target for nearly 4 years. An undershoot. Of course, lower rates would mean yet more stimulus for the Auckland property market, but not lowering rates means inflation stays lower than its official target, the Kiwi dollar stays relatively high, and exporters don't get the returns they might have been hoping for. So what about tomorrow? Well, as Bernard Hickey points out, many of those who might benefit most directly from lower rates seem resigned to the idea they won't go lower.
That's right. You hardly hear anything from the likes of Federated Farmers or Business New Zealand or exporters about that high currency. And remember, it's risen 2.5 cents in the last 3 or 4 days, partly in expectation that some people think the Reserve Bank won't cut tomorrow morning. And, in times gone past, when the currency was very high, people would complain about it. But for some reason, we haven't seen that same level of heat or complaint, in part because the Reserve Bank Board and the Finance Minister have essentially accepted this undershoot. They are saying, okay, we can't seem to get inflation back up into that 1 to 3% band, or particularly close to the 2% midpoint. But there are some extenuating circumstances, and the Reserve Bank itself has been saying, hey, don't look at the CPI number, although that's what its actual act says it should be targeting, yes, and instead look at the core inflation number. But even then, there's some debate about what that core inflation measure actually is, where the Reserve Bank seems to be the only one that knows what's in the black box underneath that core inflation number. And, there's some real questions about whether they should be cutting interest rates. At the same time, the Reserve Bank has to think about what all this means for the Auckland housing market, and that's why they're considering introducing a debt-to-income multiple limit, potentially later this year, early next year, and they've already started negotiations with the government. And that may be one of the things which pushes them closer towards a rate cut. If they think they can control lending growth, then that might help them. In fact, just in the last week, we've seen ANZ, the biggest bank, dial back its lending growth, tighten its lending criteria, particularly to investors in Auckland. And you have to wonder whether the Reserve Bank there has managed to try and control some of those expectations about lending growth to give it more flexibility on the interest rate side.
In the meantime, Graham Wheeler is making an announcement tomorrow morning. Should he cut rates?
Well, if he's only thinking about inflation, he should cut interest rates. Some people say down from 2.25% to 1.5%. Burl, Commonwealth Bank of Australia, and independent economists like Michael Riddell say 1.5% should be where it is. But he is going to worry about the Auckland housing market. And he thinks longer term what's happening with underlying inflation. I must say, given the Reserve Bank is looking to yet again tighten again the lending controls, then that gives us a bit more flexibility to cut interest rates.
You think it'll happen, Bernard?
Probably not, because the Reserve Bank Governor is seen as a reluctant cutter. And there are many within the Reserve Bank who think that the inflation dragon is just sleeping and it's about to wake up at any moment now, when actually for the last 3 or 4 years it's not just been asleep, it's been comatose.
Bernard Hickey, analyst, commentator and publisher of The Hive.